Welcome to Crypto Strategist HQ, your front row seat to the future of digital finance. Spot ETFs are changing the crypto game in 2025, making it easier, safer, and more accessible for everyday investors. In this video, we're diving into how spot ETFs work and why they might be the biggest shift in crypto investing yet. Don't forget to like and subscribe for more smart crypto insights. 1. What is a spot ETF? A spot exchange-traded fund holds the actual asset, not futures or contracts representing it. In crypto, this means the fund owns real coins like Bitcoin, not paper bets on price movement. Investors buy ETF shares, and the fund buys crypto on the open market to back those shares. This makes spot ETFs a direct exposure method without needing personal wallets or exchanges. The ETF structure adds professional custody, compliance, and regular audits to crypto access. Unlike futures ETFs, spot funds track real-time market prices more accurately without decay. Spot ETFs simplify crypto for institutions and traditional investors who demand structure. 2. Why 2025 is a turning point. Major approvals for Bitcoin and Ethereum spot ETFs are expected or have already launched globally. Regulatory bodies are softening as markets mature and investor protections become more robust. Institutions are preparing onboarding pipelines for clients seeking crypto diversification. Spot ETFs are appearing in retirement accounts, hedge funds, and family office portfolios. This influx of clean capital could drive new long-term price floors beneath key cryptocurrencies. Retail investors benefit too, gaining crypto access through simple investment platforms. Countries like the United States, Canada, and Germany are leading spot ETF innovation efforts. 3. How spot ETFs attract institutions. Spot ETFs remove custody risks that keep traditional firms from holding raw digital assets. They provide audited asset backing, daily NAV reports, and firm governance transparency rules. These features align with fiduciary duties that pension funds and institutions must follow. Spot funds allow crypto access without requiring deep technical infrastructure or new systems. Asset managers get fee income, while clients gain exposure with no new tax or storage worries. Traditional brokerages can now recommend Bitcoin without touching self-custody or wallets. This alignment lowers barriers and turns crypto from a fringe idea to a regulated asset class. 4. Spot ETFs and market liquidity. When ETFs buy coins, they do it on exchanges, injecting demand directly into spot markets. This drives real-time price increases rather than just paper speculation as seen with futures. It also stabilizes the order books with large, regulated buyers entering predictable cycles. Fund rebalancing, inflows, and redemptions create consistent volume and institutional support. Liquidity improves as arbitrage traders ensure ETF shares match the underlying asset price. This reduces price gaps between exchanges and helps smooth volatility across crypto markets. More liquidity makes the market more efficient, helping both retail and institutional traders. 5. Impact on crypto prices. Spot ETF demand is real, requiring purchase of underlying coins with every investor inflow. This creates direct buying pressure that compounds as funds attract retirement and pension money. Even moderate adoption shifts demand dramatically because crypto supply is relatively fixed. Supply shocks can trigger price surges as available coins are bought and held by long funds. These funds rarely sell, creating long-term floor support absent in retail-driven speculation. The BlackRock Bitcoin ETF alone could absorb billions, altering short-term market dynamics. Crypto assets may experience smoother price discovery and reduced speculative noise. 6. Regulatory shift and trust. The existence of spot ETFs signals that regulators now see crypto as investable, not criminal. To approve a spot fund, governments demand strong custody, insurance, and anti-fraud systems. This validates crypto as legitimate under financial law and boosts public trust in the asset. Spot ETFs act as a compromise between crypto ideals and financial regulatory infrastructure. Investors get digital exposure without dealing with private keys, wallets, or scams. Government scrutiny increases transparency, reducing criminal narratives and misinformation. Trust grows as more investors understand crypto through the safe lens of traditional funds. 7. Tax and retirement access. Spot ETFs simplify crypto tax reporting by tracking gains, losses, and income like stocks. Investors avoid tracking individual token trades, gas fees, or manual accounting headaches. ETFs issue familiar tax forms compatible with national frameworks and existing software. In many regions, ETFs are eligible for inclusion in retirement and pension accounts. This unlocks huge pools of passive capital currently forbidden from touching crypto assets. Long-term holders gain structured access with lower taxable events and stronger protections. It also encourages patient investing over quick trading, reducing panic-driven market swings. 8. Ethereum and future spot funds. Bitcoin opened the door, but Ethereum is next in line with even more diverse use case exposure. A spot Ethereum ETF would track an asset tied to finance, art, gaming, and smart contracts. That makes it a broader bet on the decentralized internet, not just digital money. Funds could eventually hold baskets of coins, tracking sectors like decentralized finance. This invites thematic investment strategies and tech innovation exposure via regulated tools. Ethereum's staking yield may one day be passed through to ETF holders, creating new products. Approval of Spot ETFs shows regulator trust in non-Bitcoin assets as well. 9. Risks and limitations. Spot ETFs are still custodial, meaning investors rely on fund managers to hold coins securely. This limits decentralization and may introduce points of failure like fraud or mismanagement. They also depend on trusted exchanges, which can still suffer hacks, outages, or manipulation. Regulatory uncertainty remains, and future rulings could impact how funds operate or report. Not your keys still means not your coins. ETFs are for access, not full crypto sovereignty. Market distortion may occur if funds hoard supply, inflating prices above real user demand. Retail investors may become overconfident, forgetting crypto's risk despite structured wrappers. Fees can erode returns, especially for long-term holders not watching performance carefully. 10. A new era for crypto. Spot ETFs bridge the gap between the crypto-native world and traditional financial systems. They bring legitimacy, structure, and visibility to assets once dismissed as risky novelties. This transformation mirrors the early stock market evolution from chaos to global standard. Crypto is entering its asset maturity phase, where regulation enhances trust and stability. Spot ETFs are not the end but the beginning of advanced, scalable blockchain investing tools. Tokenization of stocks, real estate, and commodities may follow as infrastructure grows. Investors will increasingly treat crypto as a standard portfolio component like gold or bonds. Financial education will adapt as more people learn crypto through regulated investment paths. Governments may embrace public blockchain rails as part of national economic frameworks. Spot ETFs are opening the door to mainstream crypto adoption, and the landscape is changing fast. What excites you most about this new wave of investing? Drop your thoughts in the comments. And if you're ready to stay ahead of the curve in the world of digital assets, don't forget to like and subscribe to Crypto Strategist HQ for more expert breakdowns, news, and strategies.